One Up on Wall Street by Peter Lynch is a highly regarded investment book that offers practical advice on how individual investors can successfully pick stocks and achieve substantial returns, often outpacing professional fund managers. Lynch, who achieved extraordinary success as the manager of the Fidelity Magellan Fund, shares his investment philosophy, which revolves around using personal knowledge and observing everyday consumer habits to identify profitable investment opportunities before they're recognized by Wall Street analysts. A central theme of Lynch's book is the idea that individual investors have unique advantages over large institutional investors. They can invest in smaller, promising companies that are overlooked by analysts, take more flexible positions, and hold on to good investments longer. Lynch suggests that many investment opportunities are right in front of us, whether it's through products we use daily or companies that we encounter in our lives. For example, if an investor notices a company growing in popularity or producing innovative products, this could signal a strong investment opportunity. Lynch categorizes stocks into 6 types: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Each type requires a different investment strategy, and Lynch advises investors to carefully analyze which category a stock falls into to set realistic expectations for growth and risks. Fast growers, for example, can provide high returns if chosen wisely, but also carry significant risks. Lynch emphasizes that investors should look for companies with strong growth potential but manageable debt levels and a solid business model that can withstand market downturns. A core concept Lynch introduces is doing your homework, meaning that investors should thoroughly understand a company's fundamentals before investing. He outlines several key metrics and questions that investors should consider, such as the company's price-to-earnings ratio, competitive advantages, earnings growth rate, and the quality of its management. Lynch argues that investors should invest only in companies and industries they understand and can explain simply, a concept known as investing in what you know. This hands-on approach encourages investors to focus on companies they have an intuitive grasp of, such as products they use or businesses in their local community. Lynch also stresses the importance of patience and long-term thinking. He advises investors to avoid being swayed by market volatility or short-term price fluctuations, instead focusing on the intrinsic value and growth potential of the stocks they hold. He explains that investing in high-quality companies and holding them over time can lead to significant wealth accumulation. Lynch encourages a disciplined approach, suggesting that investors diversify their portfolios across different types of stocks to mitigate risk. Another key takeaway is Lynch's perspective on market cycles and economic predictions. He argues that trying to time the market is futile, as even experts can't predict market movements accurately. Instead, he advocates for staying invested, as market corrections and downturns are temporary. Investors should use these as buying opportunities for good companies trading at a discount. Through practical examples and a relatable tone, One Up on Wall Street demystifies stock investing, making it accessible to individual investors. Lynch empowers investors to rely on their own